Hello and welcome back to All Things Money. My name is David Blain, your host, and today we're tackling a very difficult topic, which is, according to the Wall Street Journal, their headline, The Price of Taxing the Rich. And we're not trying to wade into the politics of that. We'll leave that to Phil Knight, who appears on 94.1 on the radio as well as cable TV 10. We're going to stick to the economics of it and why it's a poor economic policy to tax the rich so much. As we look at states that are dependent on the highest earning income people, the most regressive tax structures, we see that they're the ones that are in the most budget trouble. In fact, a guy by the name of Brad Williams out in California, he was the economic forecaster for the state of California. And this is amazing when you get into the jobs that people have working for government and what they do all day. And so his job was to forecast, the economics for the state, to try to come up with the budgets. Well, shortly after he got into the job, he started sounding the alarm saying, hey, we're way too dependent on a very few number of people. It wasn't in this article, but there was another study that I was reading previously. And when you look at the top 1% of income earners and break that out into numbers, you're talking about probably less than 100,000 people that the whole state of California is reliant upon. Well, anyway, so this guy, Mr. Williams, he got in this job and he started saying, hey, we're way too reliant on these few people. If they leave or their incomes goes down, we're going to be in trouble. And he sounded like a broken record, that he advocated for fiscal stability. They need to broaden the tax base. They need to have more people provide a greater share of the revenues, because he, like most of you out there, know that if the politicians have, $20 billion of revenue, they're not going to save any of it. They're going to spend it all. And so the concept of, there are some people that advocate for what they call a rainy day fund, where you keep the spending of the state, below the level of revenues, and you save some of that money for when, the economy tanks. But as we all know, the politicians aren't going to do that. They're going to spend it all. And so that generally doesn't work out too well. And so the only way to prevent this vicious cycle impacting the states is to broaden the tax base. One way of doing that is to have more people pay more tax rather than continually trying to soak the top 1%. Yes, maybe they can afford it, but the reality is in downturns of economic times, their income does go down, and it goes down much more rapidly than the average person. Part of this article, they talked about during the economic recession, the average income of the average American went down somewhere around 4% through the recession. If you look at the average income of the top 1%, it declined closer to 20% during the recession. So once again, a decline of 20% from $10 million, they're still, they're not hurting, and they're not, out on the street like the average person. This is not meant to minimize the plight of people that earn less. It's just to say that you can't rely on the tax base of those top 1%. The income's too volatile. You got to spread it out. The consumption tax is one way to do that. If you don't want to put higher income tax people on a larger base, you can use something such as a consumption tax. But anyway, so this Brad Williams, the economic forecaster there in California, he realized a couple years into his job that 90% of what he had to do was figure out how much Apple was going to make, how much Cisco was going to make, and what the owners of those companies were going to do with their money. This is just fascinating, is that the whole economy of California is a very diverse economy, that he realized that spending a lot of time forecasting that and worrying about that, they certainly did, but he realized he spent most of his time down in Silicon Valley. He would talk to the financial advisors of the wealthiest people. He would get in there and try to figure out what the plans were for Apple, and Apple stock, and forecasting the stock price. Then he found that these things were much more accurate in trying to forecast the revenue for the state of California than worrying about, their orange production or wine production or import business, that he spent a lot of time with a few companies trying to figure out their revenue and how much the owners of those companies were going to make. I mean, it's just fascinating when you look at this sort of thing. The same thing, they interviewed some people in New York. Same thing. The planners in New York, it doesn't, what happens up in Albany or Buffalo or wherever is just insignificant. I shouldn't say insignificant, but it's just not that big of a factor when they're looking at the state of New York budgeting. I mean, they spent most of their time down on Wall Street trying to figure out how much bonuses Goldman Sachs was going to pay, how much, the big banks were going to earn, because these were the people that were providing, in New York's case, 41% of their revenue. And so they realized that they needed to spend time figuring out how these people made their money and trying to forecast that into their budgetary process. In my opinion, and a lot of other people's opinion, this is just a really bad way to run a state. And so these states are in all sorts of problems. I would encourage you to go out there and do some research on your own. Look into this topic. And I think that any rational person would come to the conclusion that the extremely progressive tax system is definitely not the way to go. And we find the same thing with at the federal level. When you have this very progressive tax system, you become reliant on too few people to pay your taxes. I relayed before the break, there's been some articles on Google and GE recently. In fact, I think GE, if I recall correctly, they actually paid virtually no tax. Google pays virtually no tax. These are top companies in America, big employers. It's who Obama meets with when he's trying to talk about creating jobs. But these also, the tax department of GE employs like 1,000 people. And their mandate is dual. Number one, comply, and number two, legally avoid taxes. They have 1,000 people working to try to minimize their tax. And where if we went to a more evenly based tax system, or I'm a big proponent of the consumption tax, it wouldn't matter if GE paid taxes, because as their products were sold, then the tax revenue would come in. So it was a great article in the Journal. If you get the Journal, I'd encourage you to go back to this weekend's issue and read about it. Well, unfortunately, we're all out of time for today's show. We hope that you'll come back and join us next week. For All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.